209,000. It is a lot lower than anticipated and a lot lower than it has been. 339 last month. I'm looking for the revision to that. We'll get that in just a second. But of course, the forecast was for 230, and we had that blowout ADP number yesterday. So this is quite a surprise. Private payrolls, 149,000. That would compare with that 497,000 that ADP found because they measure private payrolls. Manufacturing up 7. That's a change from a negative number the month before. And the unemployment rate does fall back to 3.6%, which is what had been forecast. It is a little unusual to see unemployment dropping when we are waiting for the Fed to keep raising interest rates to push it up. Average hourly earnings come in stronger than expected, a 0.4 gain for the month of June, and on a year-over-year basis, that puts it at 4.4%, which is not the direction the Fed was hoping for. That's up from 4.3% in the prior month. Here's the revisions. Last month, which was 339, now revised down to 306. So a little bit weaker for the last 2 months then. And the change in manufacturing payrolls, which was -2, is now -3. However, the average hourly earnings revised up for May to 0.4, and that put May at 4.4. So basically, we're unchanged between June and May. -110,000 total revised jobs for April and May going into June. So what we're looking at is a little bit weaker than, a lot weaker than anticipated. And it's the first month in the last 15 that's come in below the economists' expectations.
All the way back to the March report of last year, which we got in April of last year.
No, the April numbers were revised down from 294,000 to 217,000, down 77,000, and then May down 33,000. We mentioned that. So you see from April, May, and June, a weaker labor market than people thought. So this is probably going to have an effect on the Fed, even if the average hourly earnings are not specifically changed. Not much change in terms of the unemployment rate. While it did go down, we saw 273,000 new jobs in the household survey last month when we went up to 3.7. So this is all going to raise the questions of soft landings and things like that if we continue in this area. I might mention that construction hiring up 23,000. So the home builders are really keeping the economy going. The other big employer was government. Government was up 60,000 on the month, and little change, a gain of 21,000 for leisure and hospitality. The BLS puts it as little change, but that compares with 232,000 in that ADP report. So ADP way off this month, and I don't think anybody's surprised to hear that, but the labor market has clearly slowed.
What was interesting about yesterday's move is that when you look at it, it's really real yields that moved up, treasuries, but also UK gilts and across the board in Europe. And you also saw some steepening of the yield curve. So the market is maybe now putting less weight on the risk of a recession, especially in the US in the second part of the year, and thinking, okay, if maybe the labor market is that resilient, the Fed can not only go higher, but stay there for much longer, and potentially well into 2024.
Well, is this a potential soft landing scenario that we're looking at now, given the strength in this labour market?
That could be a possibility, definitely, when you look at yesterday's movement. And if the ADP number is again confirmed this afternoon, that could be obviously opening the door for this soft landing scenario that the Fed is hoping for. And that potentially why also the long end moved that much, because we know that 10-year Treasury yields have been dampened by this expectation that at one point something will break in the US economy and we'll have a recession, and that could potentially lead the Fed at one point in 2024 to have to cut rates somewhat.
Okay, so you say that the market is then, we've seen steepening of the curve, and you talked about how a higher rate is then possible, higher interest rates are possible, and perhaps for longer. But how high, Laureline? Is this still the 2 hikes that the Fed has been talking about, or is this something further?
So when you look at the movement, the fact that the 2-year Treasury is now at 5%, which is something we haven't seen since 2007, means that still we're getting back to levels that we think are restrictive. Now, I would put attention also on real yields. And what we saw also yesterday is a confirmation that real yields now on the short-term part of the US yield curve are very restrictive. We're talking between 3 to 4% on the 1 to 2 year. And this is something we haven't seen for decades now. And as such, this is going to dampen economic activity now in our view.
So the 2 year currently at 4.98, just below that 5% level. Does it look attractive at that level, Laureline? Do you want to get into the front end at this point?
So at this stage, what we have done rather is be going into US investment grade corporate bonds, short-term ones. And actually with the rise we've seen on treasury yields recently, we've even decided to move overweight on US investment grade and saying, okay, maybe it's time to actually lengthen a bit the duration there. Because if at one point we have indeed some Fed rate cuts potentially in 2024, you want to have a bit more duration and to lock your coupon a bit longer.
Do I extrapolate from that you think there is still, a bit of runway when it comes to being risk on, maybe a little bit more overweight on tech and some of the same themes that we saw drive the rally of the first half in the second half?
Yeah, I think there's runway left, and I think technology is still the place to be. Growth stocks are still the place to be. Certainly did well in the first half of the year. Today it's going to give everybody some pause to see a day like today with yields spiking the way they did. But if we look at the second half of the year, we still look at a constructive environment for stocks, and especially growth stocks and technology. The Magnificent Seven, as we call them, we wouldn't be trimming those yet. We would stay with those because they're more immune to, take today, Microsoft and Apple were both positive.
So valuations at this point in that space are okay for you still?
The valuations are sky high for stocks like NVIDIA. But when we look at how we trade stocks and what we trade based on, there's concern that there would be an earnings crash, and the earnings for these companies continue to come through. Could we see a correction or more significant correction, especially in some of these high flyers? We certainly could. But looking at a long-term secular growth story that many of these stocks have, there's been comparisons to the dot-com era, but it's very different. These are established companies that are going to benefit from this AI technological revolution. And we're also seeing the leadership starting to broaden out. We saw small caps do a little better in June, and we're seeing an overall broadening of the breadth of the market.
And David, what will you be watching out for as banks kick off earnings season next week?
We expect that, certainly with the stress test, they were able to do some things with dividends, and that was a positive for banks. We're still concerned about the financial services sector simply because we don't know that we're out of the woods there. The Fed has created a problem for the banks. That's what happened with SVB and a handful of others, and that risk is still there. So I think the earnings for some of the powerhouses like JP Morgan will continue to do quite well, but the regional banks we would continue to avoid those for now. There's been some periods where they've spiked.